In this video, we're going to talk about how you can legally reduce your tax bill. But many people might be wondering, how can I do this? And what are the steps that I can follow to make sure that I can get this done? Well, the good news is there are plenty of ways to keep more of your hard-earned money back in your pocket. Whether you're an employee, you're self-employed, or you're a business owner, I'll walk you through the smart tax saving strategies that you could put thousands of dollars back into your pocket. So stick around to the end, because at the end, I will also share a bonus tax hack that most people miss out on. So let's dive right into this video. All right, so the first thing is going to be one of the easiest ways to lower your tax bill, and that is going to be to maximize your deduction. The more deductions that you have, the less taxable income that you will have to report on your taxes for that year. So the biggest question is going to be whether you can use the standard deduction versus the itemized deduction. Most taxpayers out there take the standard deduction, which in this tax year is going to be about $14,600 for single filers. And it's going to be about $29,200 for married filers that are married filing joint. But itemizing can be worth it if your deductions exceed these amounts. So it really depends on your current situation, whether you go with the itemized versus the standard deduction. We do want to go over some of the most common itemized deductions out there to make sure that you are applying them appropriately to your tax. One of the biggest one is going to be mortgage interest. If you have a home and you do have a mortgage on them, the interest associated with those monthly payments is tax deductible. Also, state and local tax, part of the SALT deduction limit, is going to be about $10,000. So if you're paying state and local taxes that are up to that $10,000 mark, then you can deduct that off of your federal tax. Also, medical expenses. Anything above 7.5% of your adjusted gross income is tax deductible. And then charitable donations. All your charitable donations can be a big tax deduction. One quick little pro tip is that if you are going to donate to charity, I would recommend considering bunching your donations together into 1 year to surpass that standard deduction threshold so that you can use that to lower your tax burden. All right, so number 2 is going to be to maximize your retirement contribution. Do you want to lower your taxable income and save for retirement? Well, if you do, then this is the way to do that. Contributing to your tax advantage account is a no-brainer. If you do contribute to a IRA or a 401k, then potentially that can be deducted, and it can give you some huge tax benefits down in the future. In 2024, you can contribute up to $23,000 to a 401k and about $7,000 to an IRA. If you're above 50 years old, then you can contribute $8,000. But for the majority of people out there, that's not going to really pertain to them. These contributions reduce your taxable income if you're doing it into the right account. Now, I do want to talk about specifically a Roth versus a traditional account. Specifically, a traditional account will lower your tax bill now, while with a Roth account, it will grow tax-free for the future, and you'll see the tax benefits later on. If you expect higher taxes later, consider a Roth IRA. Otherwise, a traditional IRA will give you those tax deductions now for your return. So basically, if you think that you're going to be in a higher tax bracket when you go to retire, then a Roth is going to be your investment account. But if you think you're going to be in a lower tax bracket at that time, then a traditional IRA will be the one that you want to use. A little pro tip is that if your employee does offer a 401k match, take advantage of it. It's a free money and it helps you save even more on your taxes. So make sure that you do at least the amount that they are offering that they are willing to match, if not more. All right, section number 3 is going to be the smart business and side hustle deduction. If you're self-employed, you own a business, or even if you have a side hustle, you have tons and tons of tax saving opportunities out there. The biggest one is going to be the home office deduction. You can deduct a proportion of your rent, your mortgage, your utilities, your internet, your phone, and all of that can be tax deductible on your return. If the IRS allows for your tax year, it's going to be $5 per square foot, up to 300 square feet for that simplified method. And that's just for the simplified home deduction. If there's other factors that go into that, then you can go into the more itemized portion of that, and it might be a little bit more. Other business expenses, if you do have a side hustle that you could use, like Uber or something else like that, or something that you have at home, you're a creator, Then business expenses like office supplies, the software you use for that creating, advertising and marketing if you do have a small business, health insurance premiums, and even if you travel or you have meals at certain locations for your business, that can be up to 50% deductible for your case. So another pro tip for this one is to keep the detailed records of your expenses using apps like QuickBook or Expensify. That way you can maximize your deductions at the end of the year. That way you can also stay audit proof and they can't come at you. You have all the receipts that justify all of the deductions that you're trying to claim. All right, the next thing is going to be to make sure that you are maximizing your tax credits. This is the hidden gold mine. If you're not utilizing this, this is a big thing that you're going to be missing out on. Unlike deductions, which reduce your taxable income, tax credits will reduce your tax bill dollar for dollar. So that means that if your tax, let's say, is $10,000 and you have a tax credit that is $10,000, that means there is no taxes due because they cancel each other out. Here are some of the most valuable ones that I want to make sure that you're not missing. One of the top ones is going to be the earned income tax credit. For a lower income worker out there, worth up to $7,430 in 2024. If you meet that specific threshold of income, then you get that $7,000, $430 tax credit associated with it. Another one is going to be the child tax credit. You can get up to $2,000 per child under the age of 17 if you meet the criteria for that. So make sure that you're looking into that because that could be something that could be a huge tax break for your return. And then the saver's credit. If you contribute to a retirement account and have a lower income, you could get up to 50% credit up to $2,000 contributed. So if you are going to be looking forward to that retirement time frame and you're going to be investing, make sure you utilize that and apply this. A big pro tip for this one is going to be many people will miss the savers credit. If you're qualified, you're going to be leaving money on the table if you don't use it. So look and see if you qualify and apply it if it's out. All right, and this is going to be one of the biggest pro tips out there, and that's going to be to adjust your withholding throughout the year. If you get a big tax refund every year, that means that you're overpaying the IRS. That means that you're giving them too much on a monthly basis, and then that you're going to get that money back to them at the end of the year when you could be utilizing it for anything else throughout the year. So what I recommend doing is I want you to adjust your W-4 with your employer to reduce the withholdings, get money back into your pocket, more money in each paycheck instead of waiting for that refund. So go ahead and talk to your finance department, see if they can start adjusting that withholdings so that it could be a little more appropriate and reduce that return and put more money back in your pocket originally. And that's really how you can legally reduce your tax bill. If you found this helpful, don't forget that like and subscribe button for more tax saving tips. And let me know down in the comments what your biggest tax question is going to be. I might cover that in my next video, so go ahead and put that down there and we'll try to respond to as many of them as possible. As always, I want to remind you that we are here from your first penny to your first million. We'll see you next time.